Are we good to go?
Just a second.
Yeah.
Yes, we are.
Okay. Dia, you could start now.
Good afternoon, everyone. I, Dia Jain, on behalf of the BRICS Chamber of Commerce and Industry, would like to welcome you to this webinar on raising fund from offshore via ECB route. The BRICS Chamber of Commerce and Industry is a parent organization which promotes commerce and industry in the BRICS nations. The Chamber, founded in 2012 with the effort of professionals and entrepreneurs, is a not-for-profit and non-governmental organization. BRICS CCI is a body and Niti Aayog and participants can please mute themselves. The objective of BRICS CCI is to create an enabling support system, especially for MSME segment of businesses, young entrepreneurs, women entrepreneurs, and startups from across all geographies. While the BRICS nations will remain at the center of all activities, the Chamber has taken it in its credo to reach out to and enable young entrepreneurs from other friendly nations too. It proposes to be the voice of entrepreneurs and helps them cultivate their businesses with due regard to social, cultural, and security issues. The BRICS investment vertical is the dedicated vertical of the Chamber that aims towards providing information about investment opportunities. It aims to provide a wholesome approach to young entrepreneurs and build young leaders to effectively articulate their ideas in a meaningful manner with respect to changing investment patterns. The vertical aims to provide a platform for networking, mentorship, partnership, and funding for young entrepreneurs in the BRICS nations. External commercial borrowings, or ECBs, are commercial loans that are made by non-resident lenders in foreign currency to Indian borrowers. ECBs have proven to be instruments that greatly aid Indian firms and organizations in their efforts to raise funds from beyond India's borders, especially in regard to bringing in fresh investments. As of today, there are two paths to raise funds by employing ECBs, the approval route and the dogmatic route. The RBI has issued circulars and formal guidelines specifying the borrowing structure. As speakers today, we have with us Mr. Dipen Shah. He's a part of the board of advisors at BFIS. He's also the founder of Offshore Fundraising, Debt and Mezzanine Structures, ECB and International Trade Finance, and advisor to the GIFT and IFSC. He's a highly motivated chartered accountant and company secretary, having more than a decade of professional experience in the banking and financial services industries. Blend of corporate and consulting roles with expertise in global fundraising strategies and arrangements. Global trade transactions, funding arrangements, techno-intelligence operation consulting in line with regulators such as RBI, SEBI, FEMA, IFSCA. He's a steering committee member of the investment vertical of BRICS CCI. The vertical will work closely with the embassy of member countries and cross-border businesses and travel investments in support to the Ministry of Commerce and Investment. Invest in India and Niti Aayog programs of India. His professional exposure includes to work with large PSUs like Bank, NBFCs, regional rural banks, BSC, NSC listed corporate, PSU corporate, MNCs, and family-owned large corporations in various capacities. He is the founder of iCasper, Capfin Advisors LLP, which deals mainly in offshore fundraising and arrangements and fund management services for deployment of funds in India and globally from offshore FI or banks. The firm is officially registered with the UK Department of International Trade for financial services for the South Asia region. Additionally, he is empaneled with the Board of Advisors to NPFC in India. The second speaker we have is Mr. Manish Sureka. He leads capital account product for retail businesses at ICICI Bank. He's a fellow chartered accountant and a master's in finance with over 15 years of banking experience. Mr. Sureka has worked closely with businesses, chartered accountants, and law firms to facilitate foreign investments to and from India. He has also led banks' technological developments to resolve and simplify coordination of capital account transactions. Some of his recent achievements include creation of pre-verification portal to simplify FCGPR filings on firms portal, digitalization of FDI remittances, among others. He's available at the corporate office of ICICI Bank at Baker. I would now request Mr. Dipen Shah to take over as the speaker.
So thank you so much, Divya, and thank you entire chamber for giving me this opportunity to deal with a very specialized subject, focusing on the entire aspects of fundraising. So we will start off the entire session in such a fashion that the entire the how to raise the funds from this ECB route, which covers the entire guidelines, which is a regulatory guidelines to be followed, and we will go through the entire understanding of the entire structures which is available to raise the funds under external commercial borrowings routes. So if we allow to share my screen, I think yeah, just I'm sharing and we'll start off this host to be allowed.
Just a sec, Dipen.
Yeah, sure.
Dheeraj, can you make Dipen a co-host?
Yes.
તમારે આવે છે ECB external commercial borrowing આવતો હશે. ચાલ બસ બેટા મોકલ્યા પછી ગુડુ.
Okay. Think it's visible to all.
Yeah.
Okay. So thank you. We'll go through the entire. The session has been divided into all the ways to take the understanding of the entire regulatory aspects from the BRICS, from the chambers perspective, and from the regulatory aspects to raising the funds in external commercial borrowings route. So this entire session has been divided into three categories. One is what is the background and what is the governing regulation that has been laid down. What is the framework? We will go through the entirely third, but I view the entire regulatory aspects of ECB framework, and the last would be keeping as a Q&A session. So yeah. Just a minute.
Entry structures, option purpose, purpose.
Okay, so any of the if you look at the entire background of the the fundraising aspects, it will be divided into the 5 routes. Like what could be the global entity structures, or what is the company structures available within the parent or the nations. What could be the options? That is the purpose of the raising the funds, whether it is through the equity. What could be they are wish to take the debt, or they are wish to take the hybrid products. I mean the mixture of the equity and the debts. What are the routes available, whether the what are the financial instruments they have to use it. So under ECB, I must say everyone get to know that it's basically a loan. Apart from that, what are the financial instruments which are available mainly for raising the ECB? That we will go through the understanding at the later stage. And what are the norms and regulatory aspects and compliance need to be followed. So any offshore debt raising or fundraising would be planning in such a large fashion that it can be the used easily for under this 5 categories. So if you look at the offshore, I think 1 minute. Give me a 1 minute. Some issue at my end. Seems like screen is clearly available, visible to everyone. I think.
Yes, sir.
Okay. Okay, so if you look at the background of it, any of the investor or lender would like to come into the India for investments or eligible or targeted entry. There are 4 routes which are available mainly for the investments matters. So that would be completely, if you look at the FPI BVR route, which is a voluntary retention route, and FCCY and the ECB route. So we will morely larger focus on the ECB matters where we have to raise the entire funds and the entire guidelines we have to understand in that sense. If you look at the entire governing regulator for the ECB, which is mainly come as a RBI as well as to the FEMA guidelines. So this purely consider the transaction, which is a external commercial borrowings and the trade credits, which is a combinedly covered as a capital account transaction under the FEMA sections of 3D, which covers that one way with the RBI permutations, it allowed to power to issue the directions how to deal with the funds aspects and what are the parameters, which gives the power under section 11 to the RBI, and the same RBI will further decided for the authorized person to be dealing into the foreign currency, foreign exchange or foreign securities. So by this power, the RBI has laid down one of the master circular which define the each and every criteria and regulatory aspects of the ECB raising. And under the FEMA, along with it can be read along with the FEMA, this type of two transactions, which is the ECB and trade credits, can be used or can be raised, or this kind of borrow would be coming under the FEMA borrowings and lending regulations. So we'll move for the entire part. So as I mentioned, this master direction has been divided into three categories or three parts. One is external commercial borrowings, trade rights, and structural obligations. We will just go through the entire ECB regulations, what is a master direction laid down, and how some any of the company which is situated in India or maybe having the outside JVWOS outside India, how they can able to use this particular route to raise the funds. So entire the guidelines has been deciphered in a very simple manner to understand what is the ECB, what are the routes, what are the options, that means a currency, what are the instruments, which is very important apart from to understand apart from the bank loan, who can raise the ECB, who are the eligible borrowers, for what purpose, who are the lenders, I mean the recognized lenders, what are the parameters other than apart from all the regulatories, that and the special dispensary which can be deals with the special category of the companies or the industries which they can able to raise the funds through the ECB routes. Let us go to the first section of what could be the ECB. It's very simple manner. It's a commercial loan. So we have to understand that it's purely a loans or debt on the books. It will be neither considered as a equity or maybe any of the matters. It's a purely a debt or the loan which can be considered for who can take by the eligible resident. It's defined under the FEMA section 2, as well as along with the reading to the income tax person definitions from the recognized non-resident entities. So I have taken a loan by eligible resident who has taken a loan from the recognized lenders and should be conform all the parameters. I mean, not, let's say there are 15 parameters. All the 15 parameters has to be fulfilled in totality, not as a standalone. It has to be throughout the things. So that is the definition which we understood as a ECB. The second part, if we come to the routes, so there are two routes available mainly for raising the ECB. That is one is automatic route and second would be the approval route. So as and when, if you look at the automatic route, so it always covers somebody else apart from the RBI. So who can be the somebody else? So that would be authorized dealer or author 81 category bank who has been permitted by the RBI under the power of the famous section 11 as by the RBI to give the vetting of the entire frameworks and to leverage the loans under the automatic route for particular entity or the eligible borrowers. And under the approval route, so whatever the parameters could not able to fulfill under the automatic route, as I mentioned earlier, that is in totality has to be mentioned or approved. That has to be go as a approval route. So for any of the mismatch in any not mitigant any of the parameters which is laid down under the regulatory, and still you wanted to avail the ECB, you have to go with the RBI approvals for that matters. These are the primarily definition that has been covered. So the automatic under the automatic route, it can be a authorized dealer that has been defined like banks or further designated authority dealer category banks, category 1 banks. So let's say ICICI Bank is AD1 bank for raising this ECB routes, ECB funding. So one of the branch which is situated outside India in UK or Singapore or maybe in India, so they can define or designated one of the branch to does this activity, that is also permitted or considered as a AD1 category bank as a designated bank. So the third, which we have to understand that it's the options which are easily available, that can be under which currency you can able to raise. It's a freely foreign currency denominated loan you can able to raise, and under the INR as well. So both of the currencies options are available. It is purely assessment has to be carried out before the raising and after the raising for any of the currency choosing basis on the business structures and the need of the funds, which has to be utilized furthermore. So the entire options of currency, the entire options, various options, who can be raised. I mean, what kind of transactions are there, which can be dealt with the foreign currency denominated ECB and the INR denominated ECB. So that guidelines has been defined under the FEMA borrowings and lending regulations, which says there are 3 regulations has been listed down over here. It purely the foreign currency raising in foreign currency, raising in rupee denominations, and that regulation governed by the foreign borrowings and lending regulations 2018. Let us go one by one. Under the foreign currency denominations, how can who can able to raise, and what type of transactions that are eligible to raise the funds? So let's say if you are raising or choosing a foreign currency denominated loans or borrowings, and if you are a AD bank or branch of any AD bank which is situated outside India, so as a bank you can able to raise this funds under the ECB route with the given this five types of purpose. So if that particular bank or branch has to raise the borrowings from their head office, right? Let's say any Korean bank or any foreign banks, let's say Citibank, they are having a branch in India, and this branch in India wanted to raise the funds from their head office. So they can able to raise subject to the fulfillment of the criteria which is defined, which has to be with the limit. However, if they wanted to raise the funds for without limit, so that the purpose has to be defined thoroughly, and let's say the Citibank of one of the branch has taken the loan from the SBI for the on lending purpose within the India, and now they wanted to replenish the entire rupee loan by taking the loan from outside India of parent or headquarters under the FCY. So they can able to raise this particular loan under the FCI, under the CCP route, for the utilization of the entire business purpose, subject to 2 things. One, the entire all the money market borrowings, whatever on the books on the date of the raising the ECB, has to be repaid, and on by looking the entire average it out, and that particular borrowings money has to be utilized for the business operations. That could be a on lending basis as well. That's a third transaction which has come as a branch which is having outside India of authorized dealer, which is having a constitution of the India. So ICICI Bank having a UK branch, and that UK branch wanted to raise the funds under the ECB. So of course they can able to do that under this route by taking the RBI regulatory norms and the guidelines which has been issued. Any authorized dealer who have been able to raise the funds under this particular route for on lending purpose, let's say for giving a pre-shipment or post-shipment limits into the foreign currency for the exporters. So let's say the ICICI Bank taking the funds from the Singapore HSBC for taking for the onward lending for pre-shipment and post-shipment credit to their exporters or their customers. So that purpose has to be defined, and they can able to raise under this FCY under the ECB route. let's say apart from the bank, who can able to raise? I mean, all the persons like individuals or maybe the company or the corporates who wish to take the loan in FCY. So what could be the transaction types? So it's not only the ECB, it covers whole in a whole structure manner, whether the which covers this entire section would be covered by the borrowings and lending regulation. So which covers ECB, they can able to raise the ECB, they can able to raise the trade rate as well, which can be for the imports of goods or maybe the capital goods or maybe the non-capital goods. The third transaction, they can avail the loan or facility which has from any of the bank which is outside India for the purpose of making the any repayments or deferments of payments where the export of services would be at the later stage. So they can able to raise under this situation as well. Any financial institutions, let's say, which is governed by the ministries or Indian Parliament Act, and they wanted to go for the borrowings of the money, they can able to do that for the on-one lending prior to approval of the Government of India. Individuals who are which can be under LRS, it can be not more than 2.5 lakhs of USD or equivalent to that. They can be able to raise the funds, or they can able to borrow from person outside India. And any individual who are the residents of India and study abroad and having a loan to repay the entire loan which has taken for the education purpose, they can, or maintenance of the their expenditures, they can able to raise the funds. So this is a whole era that under the FCY one, if finance or AD1 bank, how they can able to raise the funds, and this are other than the AD bank, how they can able to raise the funds. There are a few of the transactions that's been laid down. We'll go to the further down. If I have to raise the funds under FCY, which governs, it's a specific transaction has been given under the regulation of 6. Very interestingly, we have to understand over here, if your company would be falling in any of the parameters over here, laid down over here, and you wanted to plan your business or raise the funds from the offshore, then this is the best scheme to utilize up to the 5 million as well as to the 10 millions of a scheme where the specific approval would be required. This regulation 6 would be completely dealing into the prior approval of the RBI, under which you can able to raise from offshore bank or overseas bank or any export credit agencies or suppliers or maybe the foreign collaborative or JV or foreign equity holders, NRI, and anyone who have been recognized lenders who can be they can either they can give you a loan or they can also participating in the bonds or floating notes or debt instruments, whatever it is named for. The 5 million US scheme, this is specifically a scheme which is purely governed under the regulation 6. You can able to raise up to $5 million by the Indian entity for the general purpose, which has the minimum maturity period of 3 years. So if your purpose would be coming into this category, you can of course go and ask for the approvals and take the loan as well. The second part, which is or second scheme, which is very important to understand for infrastructure projects. So let's say I have a company is in India and wanted to borrow the any financing from my infrastructure projects. So let's say L&T is already having the multiple SPVs and multiple projects in hand for the infrastructure, and they, for any of the new allotted project, they wanted to raise or create the subsidiary or joint venture for any of the matters, and for that JV or SPV, which they wanted to take this forward, they wanted to raise the funds for the equity participants or finance the equity investments into that particular JV for the entire implementation of the infrastructure projects. So that can be done up to the 10 billion scheme under this route. This option you can able to raise or you can able to choose along with the approval by the RBI. You have to go to the entire formality has to be done. Second thing, again under this category, the best part is that the loan should not be less than 3 years. So it can be a, let's say it depends on your company or maybe or your lender. It can be a 10 years, 15 years, 12 years, 20 years, maybe, but it should not be a less than. So always in entire framework, very good option has been given that would be a minimum 10 years. It cannot be a more than, it can be a more than, but it cannot be a lesser than particular tenure which has been given. Yeah, so the second under that particular scheme, the borrowings by the exporters or foreign exchange earners, they can able to raise depending on their averaging out last 3 years of earnings for foreign earnings up to that amount or maximum to the ceiling of the 10 million. So they can able to raise the funds for their purpose as well. And the last would be a long-term borrowings, which can be a general corporate purpose with the maturity period would be a 8 years. So this is a specific scheme which is deal into this. And if your company would be falling into any of the part or any of the company or any of the projects under this scheme, there are two options with you. One, you can go or choose the regulation 6, or you can go as a ECB automatic route, or you can go as a third options of raising the funds under the other routes. Okay, so we understood the raising or borrowings into the foreign currency. Now we will come to the borrowings in INR. Multiple times we faced many of the questions that INR में क्या fund raise करें? What could be the the purpose and types of transaction that can be able to raise under the INR, which has to be raised in from the offshore. So if this governance would be, I'm just highlighting the transactions which can be having the purpose in any of the matters you can able to do or raise or borrow from foreign currency from the offshore lenders under the INR currency as well. So if you are a bank or AD1 category bank or authorized dealer, so you can able to raise the funds for ECB from the outside India with the compliant with the all the parameters which has been laid down in ECB. That may be the on lending purpose or working capital or general purpose to majorly on the on lending purpose. If you are other than the bank, these are the few transactions under which you can able to raise under which you can able to raise the ECB, I mean the INR denominated borrowings. That can be the transaction would be one ECB, second would be a trade credits, third would be you can able to raise the funds from the multi-bilateral financial institution like ADC or SARC funds would be there, or UN or WHO or IMF might be. So those kind of funds where the India is the part of that particular arrangements or multi-bilateral agreements or bilateral agreements. So from that also you can able to raise the loan under the INR denominator, provided the source of funds which those institute has raised via under the bond issuance for the rupee denominated. The natural debt raising, which can be any foreign investments or the person who are NRI, they can able to transfers by doing the transfers or any of the acquisitions, the debt would be arising. Let's say I'm taking any of the NCLT company where the debt is already there, and I'm taking those shares or those shares will getting transferred to me either in the form of equity or the security, and the debt I have to repay for that particular acquisition. I can able to raise the funds under the guidelines specifically which has been laid down as a transfer of issue shares. Any primarily deposit where I have kept or NRI has kept as a deposit, and against that I have availed any loans or overdraft, I can able to raise that particular loans under the INR denominator as well. So these are, or lastly, the financial institutions which purely governed by the government of India regulations, where they can able to raise the ECB under the ECB provisions. So these are the crux of the transaction under which INR denominated loan can be or borrowings can be raised. we yet to go into the ECB. Now we will come to the pure part of the ECB. Let us understand once we already understood what kind of the options or routes available. The second would be the what kind of the currencies or denominated currencies would be eligible for or we can able to raise and the transactions. Once we will go to the ECB, it's very important to understand. Let us know. Let us see that there are multiple instruments available for the raising of ECB. So each instrument you have to study. You have to fit your criteria under any of the matters where most of the things that you can able to raise. Let's say if you are raising a the choosing of the instrument would be one is bank loan if you are taking a foreign currency loan, floating notes or bond debentures other than the fully and compulsory convertible. So you cannot, as I mentioned, it's a commercial loan. So you cannot able to issue any of the debentures which are purely, fully convertible or compulsory convertible options. You have issued such instruments won't be eligible for under this ECB rule. Trade credits, any trade credits beyond the 3 years. Let's say if you are importing any of the import goods of capital goods and the credit period might be going more than 3 years. So again, it is become the ECB route. Any financial lease, which is very important to understand, and the foreign currency convertible bonds and currency exchangeable bonds. Again, if you are raising ECB under INR denominations, bank loan would be one of the instruments. Second, floating and fixed rate on bond debenture. Here you have the option of raising a preference share. So it's very important for any of the company who are not going for the dilution or going for not to go for the dilution and still they wanted to raise the funds on by other than choosing a bank loans. So they have the options to take the preferences, but that preference has to be other than the fully and compulsory convertibles. Any trade credits, finance lease, and the plain vanilla rupee denomination bonds, which can be issued offshore. That is a masala bond example. So after GIFT City introduced, you can choose that particular instrument as well. The question over here, whether any compulsory convertible debenture would allow the CCD, the answer is no. You cannot, because it's give a right at the compulsory converted into the equity, and the equity part won't be dealt under the ECB. It will be a purely governed by the FDI norms and FPI norms. Any NCDs, let's say I am the NBFC in India or the banks in India, and I'm issue the NCDs which having the, I do have the options. If it's a non-convertible, it can be done by a FPI, then the ECB framework won't be applicable. If it is not, then the ECB framework would be compulsory applicable over here. Let us understand few of the instruments which are the apart from the bank loan. So what are the assessments and benefit you have to carry out by choosing the instruments? So so let us go first for foreign currency convertible bonds. So these are the name itself give you the currency convertible bonds. So it can be a foreign currency denominated that you have to issue in one currency and you can be converted into the later currency as well. So this instrument again you have to follow the entire ECB guidelines and all the norms. Again, which you can able to design your requirements, and this entire the issuance of this particular FCCBs would be governed by the depository receipt mechanism, which is by later on as by the FEMA, under the FEMA as well as to the SEBI, and all the parameters has to be defined, and it should be without any warrant attached. So who can able to use this particular, or what kind of the purpose of using those kind of this kind of instruments? So generally, where you have the consortium banking in India, and maybe the ratio would be a very drastically, spread across to all the equal distributed banks. So it's very difficult to moving out the further expansions or taking the loan from the any of the matters, or maybe you have the MBA or multiple banking arrangements on the books of the parents, and still there is a scope of dilutions or the leverage is already covered. So you can consider all the entire debt at the one place and issue this kind of bonds to the offshore, under which you can able to applicable lenders can able to participate, and the entire debt can be restructured in that sense. If you are an infrastructure company, this is a good options to avail over there. Why I have to do this or choose these particular options? Because it's normally a traditional banks, the interest cost would be a much, I mean, as compared to the traditional loans and banks loans, it will be a reduction of the cost as well. It's give you the convertible options at the later stage as well. So the currency which can be multi equity capital. So the exchange rate, if favorable moves any of the exchange rate, so it gives a further reduction of the cost of the borrowing. So you have to design a structures or choose this particular instrument in a such a fashion which can be completely sitting in your balance sheet. The second instrument, which is very important, this instrument not used many of the company. This is specifically used by the promoter group company. The beauty, the interesting part is you have the parents, the parents it's in India, you have the multiple companies or JVs or SPVs, and you want to take a debt on your one company by giving the options of another company's equity. So under this kind of arrangements, you can choose this particular instrument and go for the fundraising under this particular ECB route. So who, like as I mentioned, so offered company would be the promoters group company, where the other company's dilution has to be taken, and the another company is taking the loan for their projects and expansions. The same transaction would be if you are using this particular any of the funds for the imports of capital goods, or maybe the offshore developments or project exports, or any JV or investments in outside India. So and for those purpose you need to raise the funds. So this instrument can be able to use that. In India, if you wanted to develop or you are the SEZ developers or any industrial park developers, and this options would be available, where you have the multiple countries and multiple entities, multiple currency country entities, and at the one of the entities under the FCY denomination, you can able to choose this particular instrument and raise the funds by taking or diluting or offering the equities of by in any of the SPVs or WSO or related party companies, the MBSC sectors, and however, this funds would be restricted under this particular instrument, not to use for the investments in stock exchange or stocks or real estate. Finance lease, again, the very fine instrument after the introduction of many last three years. The GIFT IFSC has been actively working in that sense, and now after COVID scenario as well, the banks are very conservative in giving the term loans or project expansion or greenfield projects. So this instrument you can use for any, let's say you have the huge capex or any machinery or aircraft or ship leasing for your business, or maybe the commercial purpose, or maybe the marine equipments, railroad rolling equipment. So large heavy machines under which you don't want to take a loan, or that particular leverage is not available on your balance sheet. Then this option under the ECB you can able to raise from outside India by taking the lease instrument as a consider. So this will also be considered as a finance lease, would be as a raising of funds under the ECB. The of course this generally many large companies has been started this activities by taking a lease out or buy or lease options, where multiple country presence of my same operations and the capex expansions or any of the matters, I will be using or choosing this particular segment or a lease option by taking the benefit of the international taxation, where the disparity of laws and taxation would be available. Last instrument we can able to understood, it's a plain vanilla bonds. It may be the purely masala amount, which I must say. So that particular for the 5 years we can able to raise this under this instrument you can able to raise even INR as well. So let's say if you are MBFC in India and for online link purpose you wanted some certain funds. So you can of course use this particular instrument to raise offshore by taking or inviting any funds from offshore as well. Any developments of township or affordable housing the projects, including the RV10 invites. So for that purpose also, you can able to raise this particular instrument by for taking the loans or borrowings or working capital to the corporates. So this is a very good benefit in terms of the currency risk would be completely mitigated. So your entire hedge cost would be out of the picture once you start or issuing this particular bonds or this instruments. And the expansion would also be goes as a offshore or maybe in the global presence, which gives you a raising of funds or expansion of any of the funds or the business in particular company, particular country from where you already have the 5 to 10 years of plan to expand their particular business in those region as well. So we understood the entire. So fifth criteria will come to the who are the eligible borrowers. So let's say if you are raising a foreign currency the denominated ECB, all the entities who are eligible to raise the FDI are eligible to raise the ECB. Furthermore, also if you are port trust or any unit in SEZ or as a Citi Bank or Exim Bank, and you want to raise the funds from offshore, so this route can be absolutely available to avail this particular raising of funds. And who can able to raise the INR? It is a little bit extensive, far more than the FCI. So who all the eligible borrowers who are eligible to raise the FCY, that is all this five, and plus the MFIs or microfinance institutions or any registered NGOs who can be also avail this particular loan under INR denomination. They are permitted to raise the funds under the ECB route as well. So these are the general open entity eligibility. Apart from that, there are 4 categories which can be a specific category can be considered. Oil marketing company, if you are a startup, if you are entity under investigation, and if you are a entity under the stress assets or NCLT or DRT. So for those, we will go through the guidelines as well. And this 4 category also can able to raise the ECB under this as a eligible borrowers. For what purpose we can able to use. So very interestingly, if you look at the negatively, so here it is excluding. I mean, it is not giving you the list of permittable transactions. The entire the slide would be covered as a you cannot raise this ECB either in FCY or INR for the below purpose. So let's say the real estate activities, investment in capital market as usual, equity investments. So this is very important to know, equity investments. So let's say if I'm raising any of the ECB funds and I'm taking this particular equity investments for my acquisitions of any JV or participating JV, except the instrument we understood it, which is a FCCB at the earliest slide. If you are using a funds raising through the loan and equip for the equity instruments, so under this ECB, it is not permitted. However, what if I have the parents in India, I have a subsidiary or JV which is sitting outside India, and I want to raise the funds from UK. Let's say I have a India parent, I have a JV in Zurich, and I want to raise the funds for the Zurich entity for the equity investment. Whether this can be permitted or not, the answer is yes. The RBI has given the very good relaxation and welcoming step to look at this. You can, so that particular things would become outbound, which is governed by the ODI regulations, and hence it is permitted to raise the funds which for the equity investments by the Indian entity from the outside India for the equity investment into the outside India. So again, apart from that, direct equity investment, it is not permitted. Working capital, it is not permitted. However, the MAMP rules defined, if those are fulfilled, then you can able to raise. General corporate purpose, you can't able to raise as an end use. But however, again, the MAMP rules has been defined. If that category would be fulfilled, you can able to raise for the repayment of rupee loan. Very interestingly, we will go will take you the case studies over there for the repayment of rupee loan as well, and on lending to the entities. So these are the basic end use which cannot be used. I mean, the funds which has been raised under the ECB, you cannot able to use under this any of first three categories, as well as all these categories, except for the working capital, general corporate purpose, repayment of rupee loan, and on lending. This four purposes has been defined. If that would be fulfilled, you can able to eligible to raise the funds. Now it's a real estate activities. If you look at very see, there are two definition has been given under the FEMA. I mean, the FDI norms, FPI would be governed as a real estate. Under the ECB, it is a wider. It's a coverage would be a very wider in terms of which covers all kind of real estate activities, which involve owning, leasing, buying, selling, renting, any commercial residence lands, or any of the activities or real estate agent would be considered as a real estate activities. So if you are into this particular business, you can't able to raise the funds for ECB under the ECB route. However, the other routes are already available. But again, having said that, if you are into the business of construction and development of the industrial park, then of course it is not considered as a real estate activity, and you can able to raise the funds under the ECB. Second, purchase or long lease of any of the industrial land, and then you develop it. So let us understand this particular case, like or the structures. So I'm buying any agricultural land. I'm converting into the non-agricultural land for the purpose of developments of any any expansions or maybe the industrial park. So whether this particular activity, for this activity, whether I can able to raise the funds or not. So answer is yes, of course you can able to do that, subject to though it is permitted under automatic route, but it is always the comfort of the AD bank. They might ask you or take you to take the permission from the RBI, but it is not considered as a restricted end use. So, or any infrastructure. So it is again, it is not covered under the real estate. So these are the end use for which you can able to raise the ECB. Who are the recognized lenders? So let us understand all the this has to be understood for one or two category, which we have to understood very good in terms of to taking any international organization of security and commissions, ISCO, or multi bilateral institutions, which can be where the India is a member country, and this list is already available. The list of country and lenders list from which you can able to raise the funds. The third section, the second would be a multilateral regional financial institutions like EXIM, or maybe the SARC funds, or maybe APEC, or ADC, ADB Bank, or those kind of institutions from which you can able to raise the funds. The third, very most importantly, individuals, they can be a lenders who are permitted if they are the foreign equity holders. And for the subscription, they are also eligible to take the subscribe of bonds, debentures listed abroad. So this we will go to the case study at the latest immediate slide. Any foreign branch of or subsidiary of Indian Bank who are permitted or recognized lender only for FC1. So again, if they can able to give the loan under the FCY ECB, not as a INR denominated, except FCCB and FCEB. This two types of instrument we understood. Under that, if Indian bank subsidiary or branch sitting outside India, they can able to give the loan under this instrument, they can be able to participate. And the rupee denominated bonds, where the foreign bank or branch or of Indian company, maybe subject to the prudential norms and guidelines, they can able to participate for arranging, underwriting, market making, and trader purpose for masala bonds. I mean the rupee denominated bonds, as we understood. So let us go to the very important definition, that is a foreign equity holder. So what does it mean? That so let's say you are, how do you plan your company where you have already good connections or group companies or maybe the friends companies or maybe the common interest person who are foreign equity holders and would like to become equity holders and for the fundraising purpose. So here, once they have the minimum holding of 25%, which is a direct holding, let's say any NRI of a US citizen acquire 26% of shares in your Indian company, and that particular NRI USA person would be raising the funds from USA banks for the using of funds in India for this company. Of course, it is permittable, and this lender would be considered as a recognized lenders. The indirect holding of equity, minimum indirect holding of 51%. We will understand this in the next slide. Let us go one. So there are three aspects where you can able to plan your fundraising under this route. One is, as I mentioned, a minimum 25% is holding, you give it to them. Basis they can able to raise the funds from either their country or any of the countries for the Indian parent which they have invested in India. The second route, which is very important, let's say we will take the we will understand this B point, which is an indirect equity holding with a minimum indirect equity holding of 51%. So that means, let's say the company one holding a 90% in company two. These are the outside India. Let's say a company one in USA, second is in UK, and third would be in Singapore. And the Singapore company would holding nearly 70% in Indian company one, and this Indian company one would further holding 100% in India SPV, let's say. So whether this company two would able to raise the funds from company one, which is sitting outside India, which is in USA, the answer is yes. By reading the entire definition of this indirect holding, so you can design your structure in such a fashion. Let's say you have the SPVs outside India or the parents outside India, and those parents having a multiple like MNCs, and they are wanted to expand or raise the funds in a particular India as a region, so they can able to raise from any of the parents or the company, related party company, where the holding would be a meeting at least 51%. The second case study, we will understand that the company two, which is holding 80% in company three, and whether they can able to give a loan to company two, which is in India. Answer is yes. Again, they can able to give the loan. If we have to understand as a conservative concept, the RBI doesn't say it's the calculative methods. If we calculate, let's say in further, the first example, the company one, which is holding a 90%, 80 and 70. So my holding of company two, which is in UK, let's say outside India, that Singapore entity's holding would be done by the UK entity, which comes with the 56%, and the UK entities, the USA holdings in UK entity would come as a 50.4%, which is not meeting the 51% criteria as per the definition. So again, if I have to take the conservative approach, then company one, who can first given the loan to the company two, which is in India, would not be eligible as well. And the third definition, where you have the group company where the common overseas parents are there. So let's say in second example, let us understand that you have the US entity and the UK entity, which is a US entity holding 100% equity in UK entity, and US entity wanted to give a loan to the Indian company having a parent relationship. Then whether the Indian company able to raise the funds from US entity? Answer is yes. The company if they wanted to raise the funds from company 2, which is in UK, 100% holding by the US entity. So the company 2 in UK and company 1 is in India, having a common parent, they can able to raise the funds as well. So we will understand from the third example as well. The company 1, USA, UK, and Singapore, and I want to raise. I am sitting in India. I want to raise where from the Singapore entity in India. So whether I can able to raise the funds or not? Of course, answer is yes. Where the common parents are there, so I can use the any leverage of any of the balance sheet or use the funds in a such a fashion where I can be able to mitigate my funding requirements. So this is the best planning for future equity holding that would be coming in your company. So other parameters which is very important as I mentioned, let us go one by one quickly. What could be the minimum average maturity period? So any funds that I will be raising from under the ECB route, it can be the common tagline would be such that it will be a minimum of the 3 years. The call or put options or earlier period repayments could not be exercisable unless you have the completion of the minimum MANP. So MNP generally it is a 3 years, minimum 3 years. Apart from that, there are below which has been mentioned as a special category. I mean the exceptions to the 3 years laid down category, where you can having the MNP with the different years along with the requirements of the funds. So let's say if you are a manufacturing company in India, and this is very welcoming step coming out. Let's say if you are raising a funds for the for any of the purpose, let's say acquisitions or maybe except which is a restricted purpose for the acquisitions or maybe the expansions or maybe the capex or general working capital purpose. And if you are a manufacturer company, you can take the loan from any eligible person up to 15 million per financial year, and the MMP would be a 1 year. So let's say this best example would be a bridge funding, where you have to mitigate your working capital requirements at the expansion stage, where the term loan you can able to raise from India as well as from outside, and apart from that you wish to take the loan for other general corporate purpose. The second special category has been mentioned, which is any eligible borrower, which has been we discussed earlier. They can able to raise the funds from the foreign equity holders for end use of working capital, corporate general purpose, or for the repayments of rupee loan. And the MAMP would be a 5 years. So very interestingly, as we discussed earlier, so if you have I will take one of the example we carried out in last year, that we been able to succeed the entire transactions for Singapore based company who has been having the JV in I'm in the WOS holding subsidiary in India, and they are the importers and availing the loan from the Singapore, and they also have the loan on their Indian books, which they wish to repayment and take that entire debt to the Singapore entity. So we raised from the Hong Kong and participating by the syndications under the Hong Kong and the Singapore banks or lenders for on this Singapore entity for against where we have already cleared the debt of the Indian entity. We release all the property, and then the entire debt is at the parent level. So the use MMP would be the minimum 5 years. So it is very benefit to the any of the corporates where they have the longer cycle durations of using of the funds. So I if I have to raise from my equity foreign holders, then I can able to raise more than 5 to maybe the 25 years, or probably, but not less than the 5 years. So you can have this cash flow enrichment at that point in time. The third category would be any eligible borrowers from any eligible lenders. Not first we understood as a foreign equity. Second would be any of the eligible lenders. That's a bank or IS4 nominated lenders, except foreign branches and subsidiaries of Indian bank. this eligible borrower can able to raise for the working capital and general purpose for the 10 years. So if you look at the MAMP would be doubled in those cases where you are raising a funds not from the non-equity holders. If you are under the third category, if you are a MBFC and lending wanted to raise the funds for the on lending purpose, where the working capital and general corporate purpose, again from if you are raising from the non-equity holders, the MMP would become a 10 years. So for that 10 years, you can able to raise the funds. The fourth category where very sound case study over here, we will understand the entire process. Let's say I am the company which is in India, and I wanted to raise the funds from any of the foreign or branch subsidiaries except these lenders for the repayments of rupee loan, which is availed in domestically for the capital expenditure. So I have made investments or expansions or any of the capital expenditure I have incurred, and I have availed the loan from the domestic banks. Now I have to take a repayments of those loans. Of course, you can able to do that subject to the MMP has to be met with the 7 years. So what is the benefit over here? There are two things. As you mentioned, as you are aware that the RBI is going to increase the INR borrowing costs slowly and gradually. And this expansion cost, you already taken the loan. Now from that particular expansion, you are going to do the exports from any of the country where you have the natural hedging available with you for that purpose, as well as the domestic bank would give you a 7 years of loan. That would be a maximum. Here it is a minimum of 7 years, so you will have a better cash flows at the initial level to take or avail this kind of loans from the offshores for the repayments of capital expenditures. And the same likewise for other than I mean, if that particular loan has to be availed other than the capital expenditure, that is also available with MBFC as well as to the any company which is in India for if they are meeting the MAMP. So let's say how the MAMP would be considered. So this is a very good formula. It's not averaging out the entire throughout all the years. The same all the norms has to be fulfilled, and it will be not averaging out. So let's say from 2007 to 2012, I have taken the loan. That would be a tenure of 5 years, and my drawdown would be in such a fashion like in a 6 month 2007, I have taken the loan of $2 million from any entity. If I have made the repayment accordingly, the year-wise balance would be like this. So here the number of days would be balanced, which the balance would be available with the borrowers. So with this formula, let's say any balance into the number of days with the particular funds is available with me, consider divided by the total loan into the 360. So this maturity would be coming as if likewise it is mentioned. So by doing this average maturity, it is coming as a 3.28. So if my norm saying that though the loan would be a 5 years, but the MMP would be coming as a 3.28 years. So can you able to look at? So I mean, it's a very good for planning to raise the ECB where you have the larger, longer period of raising the requirements of the funds, and you wanted to avail that particular funds for the longer period, let's say, which is available in India, mostly maximum to the 7 years. So you can plan this transactions under any of the purpose which is mentioned or discussed. Let us come to the cost. So every time it has come like what could be the cost? I mean, what could be the range of cost of borrowing? So we always say that it is not the borrowings only the one of the matters which considered to be a primarily criteria of raising the funds, but there are multiple objects of company to raise the funds, having inviting JV or foreign equity holders, or maybe they wanted to expand in after India to third country or fourth country, and any of the leverage of balance sheet they wanted to plan in next 10 years or 15 years. any capex they wanted to reduce in terms of by inviting at the future date of the foreign currency or foreign equity holders, or in terms of developing the entire project and later you sell it off to the or become a JV partner, or you sell it off to the, so there are multiple objects under which you have to design the entire transactions, not only to consider the fact of all-in cost, I mean the cost of the funds, but again, always it is a lesser than what I, if it is calculated with the number of years as compared to the domestic borrowings, it has to be a win-win, good situations in terms of, let's say the benchmark for the new ECB would be a maximum benchmark plus 5 BPS. That would be a, let's say the one percentage is a benchmark, and the maximum spread any of the lenders can be give it to you would be a 5. So the total cost become a 6. If you are a good rated company, let's say AA plus or AA, or I mean the very good rated company and reputed and working in many of the countries and having international rating agencies as well. So that spread might be ranging from 1.20 to 5%. So look at, might be you getting a 1.25% as a spread. So your cost would, entire cost would become a 2.25%, right? So likewise, it is a selling would be there. The RBI won't allow beyond this particular percentage to be availed. So hence we always say that you plan it out according to your rating and the requirements and the number of years and cash flow and mitigating the entire object of the company for raising the funds, and then you look at the cost. And this cost, if you are raising under INR denominated, then it's a benchmark rate, which is a prevailing a GSEC rate equivalent to the corresponding maturity. So if you are raising a ECB for the 5 years with the 1 year repayment, I mean the benchmark rate, then of course the same spread or same benchmark GSEC for the 1 year has to be used. Plus the maximum ceiling would be a 4.5. So 0.5, I mean the 50 basis points has been favorable once you raise the INR denominated ECB. Will not go to the this conversion, this activity from LIBOR to SOFR, which is currently it's the alternate rate. I mean the benchmark, which is earlier was a LIBOR, and now it is a highly accepted alternative reference rate, which currently is purely SOFR, that is secured overnight finance rate. And one time the activity has been allowed by RBI to transit the entire benchmark from LIBOR to next AAR. So those guidelines would be there. Now, apart from all-in cost would be the other cost. There are two additional costs, maybe levied over here. That is, other cost would be a pre-penalty charges, which is normally always be there in domestic sanction as well. And you can consider or bargain with your lender on the comfort of the both sides. And either of the, if you are raising a FCY or INR. What could be the other norms? Let's say the exchange rate. Now, if I am raising a FCY ECB, then what could be the exchange rate I have to consider, and whether I can able to convert this FCY to INR ECB? Answer is yes. You can able to, of course, convert your FCY ECB liability into the INR. Provided the rate has to be taken on the agreement date or the exchange rate which is prevailing on that particular agreement or transition date with the consent of all the ECB lenders. Second, again, if you have to taken this exchange rate while raising the INR denominated, so of course the conversion to rupee, all the rate which is available on the settlement date. So that you have to consider on that front as and when you apply to the RBI for the ECB. The additional cost would be the hedge norms. Again, it is a mandatory to maintain the entire hedging. Once, let's say, if you are raising a foreign currency denominated ECB, it is mandatory to hedge the entire exposure as per the guidelines. But if you are the infrastructure space companies, then up to 70% or less than 5 years has to be considered as a hedging. Apart from that, all the industry or all the borrowers under the ECB, they have mandatory to hedge the entirely portion. No portion has to be left out as an unhedged. The tenure you can use as a 1 year, a minimum 1 year, and with the options to the periodically roll over to the entire tenure of the loan. And if you have the natural hedging, as I mentioned earlier in a case study, that if you are going to expand, you have taken the loan from domestic banks and now you want to replace for the repayments of existing term loans which avail from the domestic, and from that unit you are starting the export. So the entire cost of funds would be drastically reduced, and it will give a great presence in offshore lenders and for the further course of actions to meet the objective as well. Again, if you are raising INR denominated ECB, then of course the hedging is also available to those lenders who has been given you the loan under the INR. They can able to or AD1 bank can able, through the AD1 bank they can able to enter into the any derivative instruments to hedge that particularly currency risk. Any change in currency, of course, it is allowed to FCY to INR, but however, once if you have availed any loan under INR denominated, you cannot be able to permit to exchange or convert into the foreign currency. So what could be the limits? So as per the guidelines, it is clearly that the up to 750 millions you can able to raise in any of the financial year. Very interestingly to know, let's say I have raised for the first year, I am a company having a raise in 720 USD, and now I wanted to raise another 40 within a same financial year. I cannot able to do that. But however, if I within a if I in Q4 I have planned 740 of funding that has been raised from ECB, and from the immediate next financial year I wanted to raise again 700 or 750 odds. Whether I can able to do that? Answer is yes. You can able to, of course, do that. It is every year it is a restoring the entire limits, and this limit under both denominated falling into the automatic route, subject to the ECB ratio. So up to this USD millions, you have to eligible to raise the funds as against the 7:1. So let's say you have $100 of equity, and up to the 700s of loans you can able to raise from that particular angle. If you are a MBFC, again this ratio would exactly calculated at the domestic regulated as prevail by the MBFC RBI guidelines. The equity ratio would not be a 7:1. It may be the as per the regulatory norms. If you have to avail within the same financial year, let's say 1,000 crores, then yes, answer is yes, you can able to do that, not as a automatic route, but with the approval route. Again, as we mentioned, very interestingly to know that you can able to raise the funds up to $5 million under the automatic route, where the ratio doesn't matters. So with this amount, you can absolutely raise this ECB under either of the denominated currencies under the schemes up to 5 USD. So this is the calculated terms which has been defined. You have to consider all your liabilities and all your existing equity participating, including the share premium. And if the share premium would be shared by many of the multiple foreign investors, then those investors in the ratio of holding percentage has to be considered and calculated the entire ECB ratio. Again, where if I have to raise the ECB, where do I park? So I can have, if I have to I have raised in FCY, I have the options to park my ECB funds in either outside India with any of the AD bank or the depository bank under the T-bills which has been issued by any of the country governments or monetary instruments. I can able to park those ECB outside India. However, if I have raised this particular ECB under INR, I have to bring it down to India and started using, because the intention of raising under INR denomination has to be the work oriented and the specified work purpose, and the RBI want it to use as soon as possible, and immediately you have to repatriate, though the utilization of funds would be not started. So you have to choose your date in between or while doing this INR denominated once the activity or deployments has been planned accordingly. During the COVID, they have given the 1 year of the relaxations just to park the amount. So that was that. So now very important aspects that what could be the securities. I mean, every time I have planned entire all the parameters going through, checked, going well in secured. Somehow the promoters having a back of mind that if I'm offering any of the residential or plots or any immovable property as a security, this arbitration would be a difficult for us to taken forward. So don't worry about that. It's the guidelines itself having a very good interest of the borrowers in terms of let's say the creation of charge on your immovable assets by the foreign lenders. I mean, where they have given the loans to you in India, they are not constituted as a permitted to acquire. So, and again, if they wanted to go for NCLT, DRT, or any case filings, those property has to be sold within India. So you all have the options which are available for the ARCs on from the ARCs or backdoor entries and all to avail this security. So it is very welcome, or I mean the secured provision for Indian entities where the immovable charge doesn't constitute or given a rights to constitute as a acquiring the entire assets. Charge on movable assets, again they can able to do that under any of the movable assets. Let's say if you are for the aircraft you wanted to go for the financing lease, only standalone basis on the aircraft as a security, of course they can able to take this particular security and give it to you as a loan from the AD1 bank or authorized dealers or any of the recognized dealers lenders. Charge over financial securities absolutely allowed, including the pledging of shares of the borrowing company. So this is very interesting to know that let's say if you are a company in India you wanted to give exit to one of the partner, and then you want funds from outside India, and that particular lender wish to take the pledge of shares in third country where the arbitrations and taxations matters would be let's say BVI or Cayman Island or any of the matters. So of course you can able to do that or structuring those transactions by taking the entire structuring of such instruments where this can be easily carried out. Pledge of other financial securities, bonds, debentures, GSECs, whatever available with the borrowing entity in India, they can able to do that, or they can able to offer as a security as well. Any invocation of pledge, if it is so, then it should not become the converted into the equity and doesn't give rights to cross the sectoral capping, which is defined in the FDI policy. So again, this is also preventing from preventing Indian borrowers for in favorable to the Indian borrowers for that matters. Any issuance of the corporate guarantee and PG, of course, it is considered as a security to lenders, and they can absolutely permit it. However, let's say issuing of bank guarantee by the bank or AD bank would be a constitute as a security. The answer is no. You cannot, or the bank on behalf of you would not able give the bank guarantee to third lender which is outside India for taking the funds in India. So that is a prohibited or not constitute as a security to be offered under the ECB guidelines. So special cases, let's say these are all the generic, as we discussed for the 4 entities, there's a specific guidelines mentioned apart from the above all the parameters. So let's say if you are oil marketing company, you can able to raise the funds with 3 years from, the plus point over here, you cannot have any mandatory hedge costs. So let's say if you are oil company planning a ethanol plant for expansion or taking the acquisition of those plants, and you are worried about since the business would be within India, now what could be the hedge part. So under this particular mechanism, that particular borrowings would not be considered to have a mandatory hedging. so that cost can be reduced to that extent, provided you have the board approval forex department or treasury department within your company. Again, the ceiling limit would be a $10 billion. So it's a you can overall the ceiling, the entire ceiling would be becomes a much larger than the $750 million per financial year, and all the other ECB has to be followed. The provision has to be followed. The second category would be, what if you are an entity having the investigations going on and wanted to raise the funds under ECB? The answer is yes. Of course, you can able to raise the funds, provided you have to disclose the same facts and factuals to the your lender or AD1 category banks to take. These are the situation, irrespective of what could be the or without prejudicing any of the results outcome. So it is always on the comfort of the both sides that they can able to raise, and of course they can able to raise under the ECB rule. Third, very importantly to know, what if I am the company which is having a restructure plan or resolution or NCLT, under NCLT or any DRT or SMA or NPA company, then whether I can able to raise the ECB from outside India? Yes, answer is of course yes, provided the resolution plan. So we always mention, we suggest to any of the company which is going into the NCLT or planning for the NCLT, to mention both ways. Domestically they can able to raise funds, also they can have they have permitted routes to raising the funds through the ECB or offshore. So if that line or the scheme is allowed to do so, then only it is allowed, otherwise it is not allowed. Any infrastructure company which is under the, or manufacturer company which is classified as a SMA2, I mean the verge of the NPA or maybe the NPA, and they wanted to raise the funds for the repayment of those loans. Let's say if you are an NPA company, during the COVID, many of the infrastructure companies and manufacturing companies become NPA, and they mostly the BG has been on a verge of invocation. So we normally suggest to consolidate entire debt and ask or find out the lenders from the outside India to participate in a through the various instruments which are we discuss, and which gives the later stage rights to convert as well as to participate in any of the JVs which under which your SPV or infrastructure project has been gone into the NPA. So that is the best planning under which you can able to raise the ECB as well under for this purpose. And for acquiring any of the company which is under the NCLT, or maybe the NCLT company who already raised avail the rupee loan for making the repayments of those loans, you can able to raise the ECB as well. Very important to know that a startup can start up eligible to raise the funds under the ECB. Of course, answer is yes. What are the norms for those startups? The criteria has been, it has to be a recognized startup as a central government on the date of raising. Minimum years they can able to raise for 3 years, that would be a minimum. The recognized lender, as I mentioned, FATF or ISCO bodies or regional permitted borrowers. However, overseas branch of Indian bank or subsidiary of Indian bank or any Indian company who are having a JV or WS outside India could not able to do the investments directly under the ECB route as a startups. But how after introducing the GIFT IFSC route, the other regime, by establishing the fund vehicle, you can able to find out the structures in a fashion to invest in startups as well, not under the ECB routes. What are the forms? It can be a loan or maybe the non-convertible, optional convertible or partial convertible preferences. So again, as we know that it's a purely a commercial loan, it does not give any of the convert rights to into the equity except in few of the cases. However, the additional options where I can able to take this particular fund as either in a form of loan or maybe the preferences. The currency, in both currency, of course. The swap can also be eligible by the lenders as a part of the hedging if they are giving a loan to Indian startup in INR. amount would be per startup, there would be a limit of 3 million USD per financial year. So that would be again restoring in the next financial year. Likewise, you can consider all-in cost would be it's a very good terms, like the all-in cost always prevail over there, but however here the all-in cost would be a open-ended. I mean, whatever convenient to your lender or between both of you, you can decide mutually. The end use has to be completely for the business purpose. Security, it completely depend on your borrower and between you, it's a mutually decided. And the conversion, of course, it is permitted to FCNR to INR, but INR to FCNR is not available. But again, it can be done as a considered as a exchange rate would be considered on the date of the agreement. And last things that I would like to cover, what could be the scenario? Let's say if you already have availed the ECB and having wanted to refinance the entire ECB, of course you can able to do that, provided all-in cost for the fresh ECB has to be lower than the all-in cost of the existing ECB, and the maturity period has to be fulfilled with plus limit and leverage, which is a 750 millions, 5 millions as we discussed under the scheme of 10 millions, or for the oil company 10 billions. So that has to be maintained throughout the fresh or refinancing the ECB entirely. Indian banks are permitted to refinance. Answer is yes, only for existing ECB, only for where the high rated, good rated companies or PSU would be there. They can able to finance the ECB for those companies who has been already availed from any of the lenders. Conversion to equity, ECB into equity. So let's say if you have you already have the availed the ECB and now you wanted to convert into the equity, whether it is permitted or not. So answer is yes. You have to study it very thoroughly and plan your business in a such a fashion that it can. These are the options which can be implemented in your company to plan a better way for entire raising of funds. So you can able to do including. So let's say I have 100 crore, 100 millions of ECB raised, out of which a few of the ECB has been unpaid but mature. And I wanted to convert those ECB into the equity, provided the sectoral capping has to be maintained for as per the FTA norms. I can able to do both the entire ECB, including the unmatured or matured but unpaid portion as well. And exchange rate as per the date of agreements or lesser rates as per the prevailing into the market, whatever with the less. There are three options under which you can able to convert. One is fully conversion. Of course, it is allowed. You have to file the report into the FCGPR form with RBI through your AD1 bank category, and you have to for that particular month you have to keep ECB return filings, and going forward you don't need, once approval gets through, then you don't need to file the ECB. Partial conversion is also available. In those scenario you have to continue with both regulatory filings of forms, ECB2 and FGGPR, and the phase wise, as and when you wanted to convert those ECB into equity, that is also permitted. And in a phase manner you have to file the regulatory forms to the RBI through the AD1 category. So I think it is covered all the norms which has been laid down by the RBI and FEMA. I mean, those guidelines has been discussed in toto, that every company who has been planning to raise the funds, each and every parameters has to be vetted likewise, and you have to give the answers to your company within those exercises has to be carried out. Planning has to be done in such a fashion to use the different instruments, different methods, different routes, and different purpose through which you can able to raise the funds in many of the ways as per your exact goal for the long term as well as the short term. If you are MBFC, then also currently it is a good to go in terms of cost of funds which can be drastically reduced from the domestic borrowings cost. So of course that's all from my side. I think which hopefully when I've been able to cover the entire all the proportional parameters. I know a little bit there are a long list of parameters and understanding, but of course brief and gist would be help people to understand how to take this forward. Any question answer would be welcome. Yeah, Kidaji?
Dia, can you read out the questions for Dipen, please?
Yes, I'm sorry. Am I audible?
Yeah.
Yes, so we're facing a bit of a network issue. If you could please repeat yourself.
I'm saying, can you read out the questions for Dipen, please?
Yes, of course.
And be a little louder.
Yes, sir. So we have one question from Mr. Anupam Gautam. He says, is third-party ECB allowed if the lender doesn't have any relationship with the borrower?
Yeah, third party, that means apart from the equity holders, it is of course allowed as we went into the specific cases. So that lender has to be recognized lender. It can be a foreign equity holders or it can be any of the recognized lender from the IOSCO or FFTs or multi-bilateral corporates or the MNC banks which we discuss as a recognized lender. You can avail from those corporates or recognized lender as a ECB as well.
Okay, so thank you so much. I think that answers the question. We have another question from Mr. Mahesh Krishnamurthy. He says, can ECB be done against listed entity shares in infra space by the promoters? These shares will have to be pledged overseas.
Yeah, so under the pledging as a security offering, so it can be done as offerings to the EC. I mean, the pledging of the shares would be eligible as a security. You can able to raise the funds provided all the criteria has to be mitigated. So let's say out of 15 criteria, one of the security criteria it's already there with as a pledging of the shares, which has to be convinced by the borrowers, your borrowers, where this kind of arrangements would be okay with them or not. That is the second question. But other 14 parameters, for example, that also has to be fulfilled in that sense for the availing of the funds from the ECB. So the routine question, the answer is the pledging of shares would be considered as a security would be, of course, it is considered.
Yes, sir. So apart from this, we have a few generic questions which we can take up at the end of the event. So,
Sure.
So I request Mr. Manish Sureka to please take over from here.
Dheeraj, can you give the hosting rights to Manish, please? Dheeraj, you there? Dheeraj, can you give the hosting right to Manish, please? One moment, Manish ji.
Mama, I have made Mr. Manish co-host.
Yeah, thanks, Ziraj. So a very warm good afternoon to everyone. So first of all, let me thank BRICS Chamber of Commerce and Industry for inviting me here. And what a wonderful session that we had. So Mr. Deepen, made my work much easier. He has covered the entire regulation so well and crisp that it has made my work very easy. So thank you, Deepen ji. Thank you so much. So let me share the screen. Yeah, is my screen visible?
Yes, sir, we can see it.
Okay, thank you. So we will cover, the regulation, what Deepenji covered, we'll cover ECB, external commercial borrowing from an AD perspective and the role that an AD bank, ICICI Bank plays here. So these are certain agenda that we'll cover. One is the transaction flow. How do we raise ECB? What are the steps required to raise an ECB? Second is, what is the reporting requirement to be done once an ECB, to raise an ECB and once an ECB is raised? Third is documentation and discrepancies so that we understand how to make the ECB raising process smoother. Fourth, we'll cover what are the powers delegated to an AD1 bank. Fifth, on delayed ECB2 and what are its implications. Sixth, we'll cover conversion of equity, and lastly, on untraceable entity provision that RBI has put. So to raise an ECB, one has to submit a complete ECB form, earlier known as Form 83, and now it is called ECB form, along with supporting documents to the bank. It could be an AD category bank, one bank, so where the form has to be submitted. The form needs to be complete in all respects and signed by authorized representatives. Once the form is submitted, the bank will look at the document and ensure that all guidelines which has been prescribed by RBI are complied with. So with respect to MAMP or all-in cost or various sectoral guidelines, the bank will scrutinize the entire application. Once it is done, the bank will send the form ECB to RBI. This is sent at their Bombay office, DISM, and will apply for a loan registration number, which is in short called a LRN. Typically, RBI would allot an LRN in a span of, let's say, 7 to 10 days. That is the normal time in which RBI would allot an LRN to the entity. However, this would depend a lot on the documents that are given and the way the bank scrutinize the documents. So the better the documents are given and better the bank scrutinizes it, the faster is the LRN received. Else, what will happen is there will be certain queries which have been raised by RBI and more detailing would be asked, which in turn delays the entire process. So it is very important that we submit all documents in one go, and also the bank checks the entire document and clarifies all one together. Once the LRN is issued by RBI, the same is communicated to the bank, and the bank in turn intimates the client. This is important because the client, when it asks for funds, in case of a SVY raising of funds, the sender, who is a remitter sitting abroad, needs to mention this loan registration number in the SWIFT copy. Lastly, when the funds are received at the bank, they're received in the Nostro account in case of a FCY, or a Vostro in case of a INR. And this is received as per the drawdown date. So the funds can be received only once the LRN has been allotted. Post that, the funds has to be received, and this has to be received on the drawdown date. The bank will ask for a disposal instruction from the client, and basis the disposal instruction and confirmation, the funds would be settled in client's account. This fund is settled under purpose code P0012, that is used for ECB. What are the reporting requirements in case of an ECB? Of course, first one is the form ECB, which I explained in the previous slide, where one copy is forwarded to RBI and the other copy is retained by the AD bank for its future references. So that is one reporting requirement. Second reporting requirement is ECB2. A monthly form is required to be filed by the borrower along to its AD bank within 7 days from the close of the previous month. Now these are 7 working days which are to be considered, within which the ECB2 form has to reach the Reserve Bank of India. So the client, the borrower, needs to submit this ECB2 form to his bank, and the bank in turn will again check the details, match it along with the ECB form, the terms and conditions, and accordingly it will forward it to RBI. Another reporting requirement is, in case there is any change in the terms and conditions of the ECB, then a revised form ECB has to be filed by the borrower. But this has to be done within 7 days again from any change in the terms and conditions. So these are major reporting requirements which are to be followed by the borrower. What are the documents which a borrower needs to give to the AD bank along with form ECB to make an application for loan registration number? The first and most important is a customer request letter, or you may call it as covering letter, requesting for a loan registration number. This has to be accompanied by a board resolution, a loan agreement or a consent form between the borrower and the lender. Also, it is required declaration has to be given by the existing borrowers in case they are enhancing their loan or making some changes, or they are raising a fresh ECB. Certificate of registration, which is COI, is required to also be given by the borrower. Lastly, a statutory auditor certificate is required to be given, which specifies that all ECB norms with respect to MAMP, AIC, caps, everything, sectoral caps have been complied with. So this has to be given by the statutory auditor of the borrower. Now, these are basic documents which most of the banks would require to forward their application to RBI. There are few documents which might additionally be required on a case-to-case basis and depending upon the AD bank. Now, I would also say, as an AD bank, and in my experience, we find there are certain discrepancies and which can be taken care while applying for an ECB. This will fasten the process of getting an LRN. So, for example, the covering letter has to be signed by the authorized signatory of the borrower. Similarly, a loan agreement it has to be stamped and signed as per the Stamp Act and signed by both the parties. The drawdown date and repayment schedule have to be given, and most importantly, and where I see, many times this gets stuck, is calculation of MAMP and all-in cost. The all-in cost has to be within the prescribed limits. And similarly, MAMP has to be worked out as Dipenji had shown the calculation. Your loan can be of 10-year tenure, but your MAMP, which is the average calculation, depending upon the drawdown and the repayment, can be lesser than that. So the MAMP has to meet the guidelines. Of course, since there has to be a scrutiny which has to be done by an AD bank, and similarly, there is some time which RBI will also take to issue an LRN. So it is very important that there is a reasonable timeline between approaching the bank and the drawdown date. In case there is a delay in LRN and the drawdown date is prior to getting off the LRN, then in such case a revised ECB has to be filed. So these are certain things which can be taken care. Similarly, in Form ECB, the details has to be carefully filled. For example, business activity, the category of lender, it has to meet the criteria. Whether it is an INR or FCY or loan. Similarly, the dates, the formats of the date have been prescribed in Form ECB. So it is better we always follow that format. The purpose and the details of the ECB. So all details has to be filled in Form ECB and should not be left blank. This will help in better scrutinizing of the form and a faster generation of loan registration number. Now there are certain powers which are delegated to an AD bank. So for everything, RBI approval is not required, in the sense that RBI is not to be approached for every change in ECB. For LRN, once you have received the LRN, there are certain changes which can happen in terms and conditions of the ECB. So far as those changes adhere to the AIC, which is all-in cost and average maturity, such changes can be approved by your bank. For that to happen, of course, a Form ECB, which is a revised ECB, has to be submitted to the bank within 7 days of the changes. What are these changes which a AD bank can approve? Any change in the drawdown or repayment schedule. So as I said, in case there is a change in the drawdown, which could be either due to, for example, the LRN has not been received and your drawdown date has expired, then there has to be a revised Form ECB. Similarly, there has been a change in repayment schedule. So again, a revised ECB form has to be filed with the AD. Change in currency of loan from one FCY to another. This is also permissible. However, from INR to FCY, it's not permissible. In case there is a change in the borrower company name, it is the name which is changed. So along with requisite documents, it could be in form of, change revised certificate of incorporation, form revised ECB has to be filed with the AD bank. Similarly, transfer of ECB from one company to another, change in a recognized lender or the name of the lender. In either case, this from ECB is required. Change in repayment or reduction of ECB, repayment has to be made, which of course impacts your PMP. So before doing that, you need to approach the AD bank along with revised Form ECB. Cancellation of LRN. For example, there's a LRN which has been allotted to you and there has been no drawdown. And let's say the deal between the lender and the borrower has cancelled. In such case, the LRN needs to be cancelled. For that, an application needs to be made to the AD bank. However, it has to be ensured that before cancellation of LRN, nil ECB2 form is filed with the AD bank. Similarly, change in any all-in cost or the end use, so far it is within the permissible limit, can be approved by an AD bank. For these things, the request is not forwarded to RBI and the AD bank can approve it. What if these are not done on time? So for example, a change is made in the ECB and this is not submitted to the AD bank within 7 days, the revised form ECB, or form ECB2, which is to be filed within 7 working days with RBI. This is not done within time. In such case, RBI levies penalty in form of late submission fee, LSF. How much is this LSF? If the delay is up to 30 calendar days of the due date, then it is 5,000 rupees, INR 5,000. And in case it is beyond 30 days, but up to 3 years, then it is 50,000 per year. And beyond that, it is 1 lakh per year. However, it is to be noted that these LSF are calculated for each such return which is to be filed. So let me give you an example. An entity, a borrower, has not filed his ECB2 return for consecutive 3 months, let's say January, February, and March. And he comes to file these in the month of April. In such case, LSF shall be levied separately for January ECB2, which in this case will be 50,000 rupees. For February, again it is 50,000 rupees. And for March, since it would be within 30 days, calendar days, it would be 5,000. So the LSF would be 1,05,000 rupees, which the borrower is liable to pay. In case he doesn't pay this, it will lead to compounding. However, AD banks have been advised that in case the LSF is not paid by the borrower for any delayed filing, his subsequent filing should not be held, and as a prudent practice, the bank can issue a letter to the borrower for non-compliance of ECB guidelines. Similarly, if for some reason the ECB2 filing is not made for any of the period, any of the month, the subsequent filing should not be held either for non-submission of previous filing or for non-payment of LSF. And AD bank should process their current returns. Conversion of ECB into equity. So Deepan Shah has already covered this, but I'll still repeat it, that there are 3 ways. One is the entire ECB can be converted, or it can be converted partially, or in a phased manner, that is step by step. In either of these cases, depending upon the amount that is converted, form FCGPR has to be filed for the amount that is converted into equity, because such conversion will lead to infusion of foreign direct investment. It will fall in this category, and hence FCGPR has to be filed. Before filing FCGPR and getting this converted, form ECB2 return should be filed up to date. So there cannot be any pending ECB2 return, and customer applies for a conversion of ECB into equity. However, points need to be noted before conversion is the activity in which the borrower is involved should fall under automatic route under the FDI policy. Such conversion should also not lead to any additional cost, and all sectoral caps and other FDI linked performance should be met. Also, the conversion should follow the pricing guidelines which are applicable for issuance of equity to foreign investors. Untraceable entities. So this is just to make sure that all ECBs that are raised in India are being tracked by the regulator. So any borrower will be tagged as an untraceable entity, and it is responsibility of AD Bank to tag it as untraceable entity and report it to the Directorate of Enforcement. So an entity will be tagged as a untraceable entity if it has not filed as ECB2, or it is not contactable or not responding, or responding in negative for a period of not less than 2 quarters. And also, it is not operative at its registered office. So it is responsibility of the AD Bank to visit its office to find out whether the entity is operative at the office as per its record, and they are available there. What are the actions in case an entity is untraceable? The AD Bank is responsible to report it to Directorate of Enforcement. Further, no fresh ECB application by the entity can be processed by the AD Bank. Also, no inward remittance or any debt servicing shall be permitted under automatic route. So just a few case studies. So can a company, ABC for example, which is in real estate sector, raise an ECB for construction of industrial park and township? Yes, it can, because definition of real estate have excluded the activity of construction of industrial park and township from real estate. Real estate typically would mean dealing into and trading of, properties and real estate. Similarly, can an individual be a borrower, lender in case of an ECB? Yes, if in case he's a foreign equity holder, and the definition of foreign equity holder, Mr. Deepan already covered. In case of direct it is 25 and indirect 51%, then yes, he can issue a loan to the Indian company. Amount of ECB loan as investment outside India. So can this money be parked outside India? Yes, it can be parked outside India for a period of 1 year as a fixed deposit or certain investments for generation of its income. Conversion of ECB into equity, I covered this point. Yes, it can be converted either fully, partially. However, it has to comply with various norms. And any changes in ECB can be done provided it maintains it within the limits prescribed, that is all in cost, MAMP, and that has to be reported to the AD Bank, and which in turn bank will report to RBI within 7 days of any such change. So these are certain points which AD Bank monitors and of course plays an important role in. ECB fundraising. Yeah, that is from my side. So any questions?
Dia, are there questions for Manish?
Yes, ma'am, we do have questions. I'll just share them. Yes, so Mr. Anupam Gautam asks, as MAMP is defined, what is the maximum period of refund to lender?
What is the maximum?
What is the maximum period of refund to lender?
Refund.
Yes, sir.
Okay. So see, the MAMP is the minimum period. So if he's asking, if I understood the question correctly, he's asking in case a prepayment is done. So in case a prepayment is done, still the MAMP norm has to be met. So for example, in case the MAMP prescribed is, let's say, 5 years, and the ECB that is raised is for a MAMP of 7 years. In case a prepayment is done, the MAMP has to be for at least a period of 5 years.
Okay, sir. So apart from this, we have other questions also. So these are general questions which we had taken from the audience earlier. What is the ceiling prescribed for the ECB?
I think,
Audible?
yeah.
Yes,
Can I
sir.
go ahead, Mr. Manish?
Yeah, Dipenji.
Yeah, so it's already covered that for oil company it is $10 billion. For other than those category, it is 750 per financial year, and specific schemes are there who can be able to avail as under a $5 million scheme or under $10 million scheme.
All right, so thank you. Apart from this, what are the reporting prerequisites for converting external commercial borrowing into equity?
Okay, so conversion of ECB into equity. See, again, this can be partially done or fully done, but two criteria that has to be met is, one is the MAMP norm, has to remain in case it's a partial. Second, there cannot be any additional cost for conversion of equity from ECB to equity. Third, the activity in which the borrower is there, it has to be within automatic route in FDI policy. In case the activity does not fall under the automatic route, then government approval is required.
Okay, all right.
Also, the pricing guidelines. Finally, the pricing guidelines which are applicable in case of a FDI, the conversion, once the ECB is converted into equity, the pricing guidelines has to be adhered to. So that calculation norm has to be adhered to while conversion of ECB into equity.
Right, sir. So after this, we have what are the hedging requirements under extra commercial borrowing?
Yeah, for the hedging, as we already gone through that criteria, it is very simple. It has to be completely hedging. That is a 70% for the infrastructure. Other than that, it's a completely hedge would be a prerequisite if it is under FCY, and under INR it has to be allowed to hedge from the overseas lender as well. For taking the hedge risks, currency risk in INR. The natural hedging would be considered accordingly as per the calculations of the underlying cash flows and the foreign currency receipts.
Okay. We have one more question. Are FCEB, that is foreign currency exchangeable bonds, permitted under the ECB route?
Yes, we already gone through the instrument part under which this instruments are very much available and can be used as a promoter group entities to structuring or planning to offer the shares for any of the offered companies.
Yes. Am I audible?
Yeah, you are audible.
We have two more questions. Is corporate and personal guarantee allowed under the ECB framework?
Yes, it is allowed as a part of the security, as we discussed under the slide. Of course, as I mentioned, that being BG, bank guarantee, as a offered as a security won't be allowed. CG, I mean the corporate guarantee and personal guarantee, of course, it is considered as a security.
Right, sir. One last question. Can ECB be raised under track 3 for general corporate purpose, that is including working capital?
Yes, so the permitted end use, which has been already mentioned, the working capital, the general corporate purpose, and on lending matters, also to the making the repayments to the rupee loans. So under those category, including the MAMP norms, as we discussed, that can be absolutely permitted end use, and provided all the other parameters should also get fulfilled.
All right. Thank you so much, sir. With this, we come to an end to the session. I would request everybody, including the participants and the speakers, if they can turn on their camera so that we can take a picture for our page. Thank you, sir. Thank you for your time.